63% of Texas manufacturers are reporting worsening conditions, but they're not the only ones. As we look around the country, there's major problems showing up across the manufacturing sector, telling us that the economy is about to head in the wrong direction. But at the same time today, we heard from the federal government that the outlook for the economy is improving. And what this sets up is for the potential for some major policy mistakes. But on top of all that, we have stock market that's pushing to new all-time highs as investors continue to point to the stock market as a sign of economic strength. But if what's happening in Texas is any indication of what's to come, well, the stock market's got this completely wrong. Now let's head over to Texas, where we picked today's story up as we look towards the Dallas Fed Texas manufacturing as production remained flat in June. But as we look underneath of what's happening in Texas, you can see this as a major warning sign for the economy. New orders index remained negative but edged up to minus 7.3 from minus 8.7, meaning demand continues to weaken. And one of the key points in the manufacturing sector is that new orders lead to demand for labor. So if we continue to see a contraction here, well, there's a nightmare scenario setting up for the U.S. workforce. The capacity utilization index was also largely unchanged at minus 1.0, suggesting that factories were running at about the same production, but shipments index fell 8 points to minus 7.3. And this is a major red flag that we're starting to see show up in a lot of the manufacturing surveys, is that production levels are relatively unchanged, but there's an issue. Shipments aren't moving. So what is this telling you is happening in Texas? Is they're building inventories. The problem is we're seeing inventory building all across the country. And if demand doesn't pick up and capacity doesn't hold out, well, watch out below. Let's take a look at this slide and understand the relationship between new orders and capacity utilization. And you can see very clearly that a new order book for Texas in blue against a broad capacity utilization index for the entire country. You can see the very clear relationship where new orders go, capacity utilization eventually follows. And the problem is there's a strong link to capacity utilization in the labor market. And what this is an indication that if demand doesn't pick up, and soon, well, what we're facing is the manufacturing sector is going to stop building inventory, and when they do, they're going to be forced to cut jobs. And so you start to understand the major risks the economy is facing. What's happening in Texas, as we said before, was spread all across the country, and now it's happening. As we look to the labor market, well, in Texas, they actually increased employment. As we see, the index moved up 2 points to 5.7. But again, we talk about red flags in the economy and the labor market. The hours worked index remained negative and fell 5 points to minus 8.4. And my friends, that is the worst since the pandemic. So you start to understand what's happening here is there was a lot of momentum behind the manufacturing sector for all this inventory building, but many people believed it would persist and continue. So what you're seeing in Texas is they staffed up a little bit, but demand wasn't there, so they started to cut hours. But wait until you see the broad manufacturing survey. It points to a lot more red flags showing up. But let's talk first about the relationship between average weekly hours of production and non-supervisory employees versus the current employment diffusion index for Texas. And what I want you to see is even though Texas hired, the risk is they cut hours. And you can see the very clear relationship. When weekly hours shown in red decline, what it means is at some point the employment index is going to follow. So this is again a major red flag for Texas, suggesting that some of these employees that recently got hired could find themselves very soon on the unemployment line. And yet was a further issue that we're facing in the manufacturing space, which is driving a lot of this inventory building as elevated price pressures continue in June while wage growth remains rather subdued. You know, we've talked about how these tariffs are actually a tax. And normally when producers raise their prices, they're able to pass on some of that to their employees in terms of higher wages or more hours. In this case, price pressures are going up, but there's no way for workers to benefit from that, which is why you're seeing now employers saying, look, we can't pass this on. We can't give you out bigger raises. And this, again, a major problem is wages and benefits have slipped further below average. Because the underlying issue here is all about demand, and what we're hearing from a lot of customers is they're saying, look, we're in a wait and hold. We don't want to buy right now. We want to see what's going to happen in the economy before we do anything. And so to get ahead of any price increases, what the manufacturers are doing is they're front running this, they're building inventory. But if demand doesn't come, the risk is we head right into a recession. And when we look at the primary concerns about Texas manufacturers, it's demand and potential recession. Makes perfect sense. If you're building inventory and you've got no one to sell it to, you've got a major problem, because once your warehouses are full, that means production stops and you lay people off. The other risk is you just go into a recession, which would be a natural response to this. But no one expected, though, post-pandemic, is that we would have an inventory recession. And this happened because we drained the shelves during the pandemic, but now due to the trade war and all of the front running of price increases, you're seeing manufacturers, wholesalers, and retailers start to build inventory. The problem is, if demand doesn't pick up, what you're going to see is disinflation and potentially all-out deflation hits the economy. And you start to understand how this can easily happen. Well, Texas made it very clear. We're not giving out big wage increases. In fact, wages and benefits are trending below average. And this is a major problem. As workers look and see prices going up, they know they can't afford them. But there's another issue that's plaguing Texas, and that's crude oil prices. We've talked about the relationship between the oil markets and, of course, the actual We've talked about the relationship between oil prices. We've talked about the relationship between crude oil prices and the Texas economy. Now, keep in mind, President Trump wants to bring oil prices down. He wants to bring inflation down, and he knows there's a link between the two. We said there's a major problem with this. If you bring oil prices down, you run the risk of unwinding the entire Texas economy. And as you're about to soon see, what's happening in Texas is, again, spreading all across the country. Let's take a look at the general business activity for the manufacturing sector in Texas. That's shown in blue against crude oil prices in red. And here you can see a very clear relationship between the two. But there was one outlier here. You saw a lot of front running of tariffs that did not lead to a broad increase in demand. The risk now is, if we continue to see oil prices weaken, what you're going to find out is a lot of oil producers are not going to be in a position to go out and explore new fields, to put in new pumps. They're not going to need as much labor. And the issue is, when they start laying off, well, it's going to impact the Texas economy in a major way. On top of the fact you're seeing a manufacturing slowdown, we know what happens after that. Within a few months, it has a major impact on the services sector. Of course, the problem is, we've already seen it from Texas. We've seen services sector declines. We're seeing layoffs there. And again, it's spreading in a major way. But the government, they've got this wrong. They keep saying that the economy is improving. In fact, when we turn to the JOLT survey, it says the economy is looking a whole lot brighter all of a sudden. Owning gold is often talked about during times of economic uncertainty. While some choose to hold gold to diversify their assets, there are other options to make your gold potentially more productive. Monetary Metals presents an opportunity to turn your idle gold into a productive, yield-bearing asset with the potential to pay you more ounces of physical gold every month. The income is earned in gold, not dollars, not IOUs, but actual physical gold deposited into the account every month. The approach allows gold owners to potentially generate yield while retaining ownership. Go to monetary-metals.com/Stephen to learn how you may be able to start earning a yield in physical gold and silver today. Again, that's monetary-metals.com/Stephen. There are risks to any investment. Risks of leasing gold include, but are not limited to, loss of gold principal from leasing to Monetary Metals and other counterparties, shipping, or any other time gold is in transit. If you purchase gold through Monetary Metals, you may pay up to 0.75% over spot price. Additionally, the price of gold may experience a substantial loss without assurance of rebounding. This is not a recommendation. Before making any investment decision, it's crucial you conduct through research, understand the terms of participation, and assess potential risk. Go to monetary-metals.com/Stephen to learn how you may be able to start earning a yield in physical gold and silver today. Again, that's monetary-metals.com/Stephen. As U.S. job openings unexpectedly rise to the highest since November. It wasn't long ago that the media was shocked when things were going down. Now they're shocked when things are getting better. But when you compare what's going on between the government and the surveys, you have to question who's got this data right. We tend to believe the surveys are right, but let's talk about what the government sees. They're seeing the available positions increase by 374,000 to 7.77 million. And one thing we do know, it's not the manufacturing sector, because when we look at Texas, and we're going to look at the broad ISM PMIs here in a moment, what you see is continued slowdowns. Now, Texas did say they hired, but the problem is they still cut hours at the same time. So on net, there would have been a decrease. But if you can see where the hiring is at, it's in leisure and hospitality. But the key point here, layoffs have declined declined, pointing to a stable labor market despite economic uncertainty. And one thing we do know that is full of economic uncertainty, and that is Federal Reserve policy right now. They're very uncertain. And one of the issues is they're worried about inflation. But we do know that former Fed Chair Janet Yellen's favorite survey was the JOLT survey, despite the fact that it's extremely inaccurate because a lot of businesses don't respond to it. And we know, of course, Fed Chair Powell was her protege. He's obviously going to be looking at this to show some sign of strength in the labor market. But again, you looked at Texas. What did they just tell you? That despite hiring, they're cutting hours. For those who do have a job, it means their paychecks aren't going as far. They can't afford higher prices. But just because we're seeing Texas higher doesn't mean the rest of the country is. In fact, they're laying off. As we now turn to the ISM manufacturing PMI, and much like Texas, held fairly steady, only showing a slight contraction at 49. And when we look at the headlines here, you see new orders and backlogs contracting, production growing, employment contracting, prices increasing, but yet at the same time, exports and imports contracting. What is that telling you is we're seeing inventory building in the data. Let's look at the report here because it's very clear what's going on. And what we're seeing here is evidence that manufacturers are not hiring. You can see the employment index at 45. Now keep in mind, under 50 is a contraction, meaning on net employers are laying off, and for good reason. Look at the new order book. It's in contraction still, now for the 5th straight month. So again, we talk about that relationship between the new order book and employees. As you have more orders, you give your existing workforce more hours. But as the order book continues to expand, then you bring on more employees. But there's another red flag in this report, and it has everything to do with backlogs now contracting for the 33rd straight month. So what we're seeing here again is clear evidence that manufacturers are front running the tariffs. They're trying to build up inventory because they believe prices are going to go higher. And the problem is, while they are seeing some of that pass through, they're not seeing enough of it. And the real fear is they think prices are going up a lot higher. And you can see very clearly right now that input prices are surging. Many manufacturers believe that we haven't seen the full force of the tariffs, and that is soon to come. And so what that means, again, they're building inventory here, but the problem comes back to consumer demand. If demand doesn't pick up, at some point, you're going to see that momentum in the manufacturing sector completely stall out. But one of the questions is it just the leisure and hospitality sector that's driving the JOLT survey higher? Well, there could be another factor, and that's the stock market. We can take a look at the JOLT survey shown in blue against the NASDAQ 100 in red, and you can see the relationship here is very clear. And you can see a deviation right around 2022 where the stock market continues to push higher today, making new all-time highs as the JOLT survey continues to go down. So is this a question of confidence among employers? They see the stock market going up, they believe in the wealth effect, and they understand that if Americans feel wealthy, they'll go out and spend. But the problem is, it comes back to the rank and file worker who doesn't have all of their money tied up in the stock market. They have to live paycheck to paycheck, and right now their paychecks are shrinking, their hours are getting cut, and prices are set to go higher. So it's possible that this may be just a seasonal effect as we look back to the leisure and hospitality sector, but there's some major problems with that, as those jobs are relatively low paying compared to the manufacturing sector, which is why we see when the manufacturing sector goes, the services sector follows with a lag. But there's another problem. It's this trade war that could potentially bring the manufacturing sector in the U.S. here to a complete shutdown. Let's turn to this headline. Where U.S. Treasury Secretary Scott Bessent says the U.S. hopes to see China magnets flow at a faster rate. And this is a major problem for the U.S. economy because we've already seen slowdowns. And yet Bessent said, look, we have a deal with them. They're going to increase the flow of these rare earths. The problem is we're not seeing it yet. And rare earth magnets are flowing, he said, but they're not flowing as they did before April 4th. And yet we're confident that the Chinese will live up to their side of the deal. The question is, will they actually do that? And this is having a major impact on companies like Ford and Dexter Magnetics, who since April have only had 5 of their 180 export licenses approved by China. So what we're seeing here from U.S. manufacturers is they have no choice but to build inventory here because they don't know where their supply is coming from. And if we don't get the supply of rare earths we need, it could lead to production slowdowns, could lead to factory shutdowns. And for workers, hours getting cut is going to be the least of their problem because they're going to be facing losing their job. job. So we can see the risk here that's happening in Texas, that's spreading all across the country in the manufacturing sector, could get significantly worse. But because of data points like the JOLT survey that only show that things are getting better, what we're facing is the potential for some major policy mistake by the Federal Reserve. As Powell reiterates, the Fed would have cut more if not for the tariffs, and what this is doing is putting the Fed chief in a major bind here. Let's take a look, because he says, in effect, we went on hold when we saw the size of the tariffs, and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs. And some of these estimates point to the fact that apparel prices could go up by 65% and the shoe prices could go up by 87%. So the fear of inflation here in the Fed's mind is very real. We think that the prudent thing to do is to wait and learn more and to see what those effects might be. So what Fed Chair Powell is saying is, look, while everyone is calling for a rate cut in July, right now the probabilities of that is decreasing by the day. We're watching. We expect to see over the summer some higher readings. He added that policymakers are prepared to learn the impact could be higher or lower, or later or sooner than we expected. The U.S. Central Bank is wrestling with an awkward tension between its forecast and the recent data, and all this tells us is the Fed expects inflation to surge over the summer. The problem is what we're seeing in the Texas manufacturing sector that's spreading all across the nation is telling us if there's any further slowdown in manufacturing, if we don't get the rare earths and companies are forced to have production cuts, what we could see is a major unwinding of the labor market. Hours could get slashed, jobs could be lost, and at that point, what you're facing is a Fed that's not just wrong, a Fed that's massively behind the curve, and in that case, there'll be little to do to stop the direction of the economy, and then the risk is we head into an all-out recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.